My name is Lana Ward and I'm a distribution manager here in Melbourne. Thank you for joining us. Today's session is on the Pengana Emerging Companies Fund, a specialist small cap strategy with a 21-year track record of outperformance. This is a true stock picking fund that avoids the noise, focusing on high quality and cash flow backed businesses. The fund also excludes resources, loss makers, or anything too speculative, making it quite different from the benchmark. The portfolio managers, Ed and Steve, are incredibly active with meeting management. On average, this works out to be one company meeting per day, every day of the year. And with over 2 decades of investing behind them and seeing many market cycles, they are truly a safe pair of hands for your clients. I'm pleased to be joined by Ed Prendergast, co-portfolio manager of the fund. Ed will take us through portfolio positioning, key market themes, and where he is seeing opportunities and risks today. Please feel free to submit any questions you may have through the Q&A box at the bottom of your screen, and we'll get to as many as we can at the end. So with that, I'll hand over to you, Ed.
What I'll do is, so as Lana mentioned, I'm one of the co-managers, and I'm just going to give you a little highlights. I'm going to assume that most people who are involved today have some background in the fund, but for the sake of a very quick introduction, when we formed the business 20 odd years ago, we set ourselves, I guess a set of parameters that we would use to invest, and nothing has changed since then, nor has the personnel. So Steve and I run the fund together, Steve Black and myself, and we have no analysts, we have no staff within the fund business, and that's never changed, and neither of us have left, obviously. And nor do we run any other funds within Pengana or anywhere else. So it's a single product. We only do this, and that's all we will do. And if I pulled up the slides that we put to prospective investors 20 years ago, they would be pretty similar, other than that, we're further down the track. The way we invest has never changed. As Lana said, we consider ourselves to be fairly conservative investors, in that if we can't understand something and value it, we're not interested in investing in it. And certainly resources stocks are for others. That's a sector other people are happy taking the risk on, but that's not something for us, nor are biotechs and loss makers and things that we really, conceptually sound good and they can fly around and get very exciting. But we put that much closer to gambling than investing. We want to buy businesses that make money in a semi-predictable way, or as most predictable way as we can, and buy them and hold them for a long period of time. So I'll just take you to the numbers, the performance over a long period of time. You can see, so the time horizons extend to the right. So since inception in 2004, we've and this is after all fees, we've delivered almost 12%, which is twice or more than twice the small industrials index. And the beauty of compounding is, it doesn't sound like much, beating a market by 7% per annum, but when you do it for 20 years, you end up with a compounded effect. And so that $100,000 invested at the start when we started the fund is worth almost $1 million now. And if you invested in the market, it'd be worth about a quarter of that. So again, the compounding effect is very significant. And Steve and I, we were the first two investors in the fund. I've never taken any money out. In fact, I put some more in recently. I've been topping up the whole way. And so everything we do when we talk about investing is what we do personally anyway, because we're investing through the fund. It's not just a brochure that we like to read out. It's where our money is. So if you look at the excess return over, so this is our return compared to the market over a long period of time. You can see, and remember, we've had a GFC and COVID and all sorts of weird and wonderful things, tariffs, we'll call it what you will. So the performance track record has been reasonably consistent. And if I was to sort of explain to you what we've set out from the start and put it into a chart, and thankfully the numbers prove this, and it's worth spending a quick second on it. It's this chart here. What it shows you is the yellow is the performance of our fund. On the left-hand side, it's when markets go up, and on the right-hand side, it's when the markets fall, and it's by month since we started. The blue is the market. So to summarise it, 2/3 of the time since we've been open, the market has risen, and in those months that it's risen by about 3.8%, and we've captured that and a little bit more. When the market falls, and typically when markets fall in small caps, what gets swept out very quickly is that which can't be valued. So stuff that's completely overvalued, or it just cannot be valued, or it frankly is junk. They're the sorts of things that really have no valuation support when the market is challenged. And you can see over our journey, the market has fallen in 1/3 of the months. It's fallen by 4%. We've fallen by about 3/4 of that. Now, that doesn't sound that impressive until you go back to this chart here and realize that all of that adds up to 3 to 4 times the market performance over that period of time. And again, when I describe to you the way we invest and what we try to do, we try and buy things that it's to us, it's about quality, and quality matters when the market falls. It's the sort of thing that has valuation support and some sort of sensible framework for valuing. So that's the history. And then I just wanted to touch on the internal culture. It's weird when you talk about the internal culture of a business with 2 people, because that is the culture. There is literally just 2 of us. But it's worth sort of fleshing out just briefly. I used to broker to fund managers for 10 years prior to doing it myself with Steve. And so I saw a lot of different models and different ways of doing things. And one of the things we weeded out from the very start was any sense that either of us wouldn't have any incentive to compete with the other. It's really important to understand how teams work in funds management, and it's probably a good explanation of why Steve and I have been able to work together reasonably harmoniously, very harmoniously. We often have heated conversations about individual stocks, but the heat never boils over because there's no incentive for us from one to gain over the other. And if I can summarize, so we don't have attribution. At the end of the year, we don't do who did better, who called the stocks better, because we don't actually call the stock separately. We do all the work together. We make the decisions in a joint sense. We would never invest in a stock that both of us don't exactly want to invest in. We can always move on to another one, and we've had plenty of those where we've disagreed on stocks, but we just move on. There's 800 things we can buy, and we want to own 50 of them, roughly. The team's small, and we, as I said, that consensus of decision-making process and the lack of attribution means there is no reason for us to compete. But more importantly, that matters when you make a mistake. And if we get 7 out of 10 right, that's a very good track record. You can't, obviously, it's not the sort of thing you want to hear from a pilot or a dentist, but we do have a margin for error. We are in the game of risk. So when we get things wrong, the fact that there's no blame internally means that there's no sense of drama, or you did this to me, or how are you going to get us out of this? How are you going to fix the mistake? And therefore, there's no sense of denial and anyone getting defensive about a decision. We just move on. If we make a mistake, we move on. It's not something we get hung up on. And that sort of culture is very hard to replicate in a larger team where internal competition is often encouraged. So let's go on to the markets and more relevant sort of stuff. I've got some comments on broader themes, but obviously what's going on in the last 6 weeks, or when was there was April the 2nd, so it's not even that, it's really 3 or 4 weeks, has become very topical and reminds us to a certain extent of some of the attributes of the market's activity, the market's behaviour during COVID and the GFC. I don't think it's as dramatic, and certainly the market fall has not been, nor would I in any way predict it to be. But there's a sense of chaotic. Every morning is a new morning, and there's nothing. So there's nothing about Trump's tariff policies that I'm going to sit on a webinar and tell you that I'm smarter than the market on, or Steve is smarter than the market on. We all just wake up to the news every morning. The RBA has no idea. The Fed has no idea. Not even sure if the administration of the US government has any idea how this actually plays out. So therefore, the markets are all over the shop, and it's a bit like driving a car in the gravel without holding onto the steering wheel in a global sense. No one's really controlling what's going on. But I would say that the sense of the sky is falling and the preparedness of the media to capture to tell, if you ask the person on the street how the share market's going, and I get this from friends and family, they say, "Oh you must be struggling, or your world's collapsed." And in reality, the US market from today is off less than 10% from the peak on February the 17th. Sorry. So a 10% correction in any market is, to me, noise, but it's not noise what's going on with the tariff policies, because this could have a significant impact on various parts of the economy. So to reflect back more relevantly, we watch share prices fly around every day. That's not in our control. We definitely do not let go of the steering wheel in our portfolio, but we just contemplate, what does it mean for our actual stocks? We only really hold 2 stocks that have any exposure to tariffs. Breville is a reasonable holding of ours, and Lovisa, which I'll go into. I'll go into Breville in a bit more detail. But if just to catch the sort of how we've performed in the last little while, the industrials in our world are off about 11%. We're off about 12%. So we've done a little bit worse over that short period of time. The 2 or 3 stocks that have hurt us the most are things like Pinnacle Investments, which is a business that is leveraged to the equity market, and it's fallen 32%, and so has KKR and Blackstone in the US, about the same. That's why you don't want a huge exposure to companies like that, because when it goes down quicker. Zip is exposed to US consumer activity, and that fell very quickly. It's a very small holding of ours. Breville, I'll come back to. Hub and Netwealth fell 15%. Well, they actually fell by 20% very quickly and have bounced a bit since, and their earnings are leveraged to equity markets. They always fall very quickly in these environments. And then it's sort of value and defensive stocks that have protected us a bit. You've got a couple there in the list. Now, what it means for the global economy, no one knows. As I said, the preparedness for everyone to predict a global recession, it sells in a lot of newspapers, but we'll wait and see if that's the fact. We haven't got anywhere near the information required. And we invest in stocks that are largely immune from economic cycles as much as we can. But I would say that this is a classic markets. When markets shoot first and ask questions later, it's a lot of it is irrational. It's hysterical, and I mean there is hysteria. And when you've got longer time frames, and so for example, Hub and Netwealth fell very quickly. We're able to top up. We're not trading actively around this, but there are certainly instances where calmer heads will prevail. And I'm just going to bring up Breville as an example. As I mentioned, these guys import from China largely coffee machines and benchtop appliances to the US. The US is their biggest market. Now, if we go back to 2018, Trump first put in 25% tariffs in 2018. It doesn't really show up in the chart here, but you can see the share price had fell from $13 to $10. So it fell very quickly, and that was because the price was going to have to rise. And the sense immediately, the shoot first, ask questions later sense was that Breville's going to struggle to sell at a higher price, and that was the proposition at the time. The company said, well, if logic would prevail, you would assume we sell lower volume but at a higher price, and therefore the effect could be largely neutral. Now, that's exactly what turned out to happen. So if you reacted to the Breville tariff noise in 2018, you would have sold the stock at $10. It was $20 a year later and $30 2 years later. Their earnings grew by an average of 13% through that period. Now, where we sit today, I'm not telling you that's going to happen again, because the tariffs being proposed, well, depending on which day we are at, are much higher than 25%. But Breville fell by 25% straight away. So we think that, and as I said, there is uncertainty here, but ultimately higher tariffs, lower volumes, it could be a neutral environment, and time will tell. But this is a business that has been growing earnings at 15% for a long, long time, and it's growing to Europe, other parts of Asia, and the like. So we're not going to panic on this one. So then if we just a quick comment on the economic backdrop, well, actually, I'll tell you what I'll do. I would rather just bring it back to a quick sketch of our portfolio, because any comments you hear from me on the economy have to be put in context, and that is that cyclical businesses, which do rely on the economy, only make up about 15% of our portfolio. Most of our stocks are companies that don't have any economic sensitivity or very much at all. And the most obvious one is Propel Funerals. It doesn't really matter what happens with interest rates, consumer sentiment, the building cycle, mining activity, call it what you want. That business is going to, the earnings will be determined by the death rate of the year, and that is completely separate from any economic cycle. And there's plenty of other stocks that I'll sort of bring out that's where most of our business investments are. You can see it's about 2/3 of the portfolio. And those businesses are the ones that we like to identify, buy, and hold for a long period of time if their performance and their valuation stacks up over that period of time. The cyclicals, we want to make sure that if we invest in cyclicals, they're growing. It's things like Lovisa, which is rolling out stores, and Beacon Lighting, and Seven Group. And so you take on some cyclical risk, but assuming that they can grow, then really the long-term returns we derive from the growth, not the cycle. And then the financials, that's where you find things like Hub and Netwealth and Pinnacle and MA Financial. So we invest in stocks that are exposed to the share market. If the market falls, they'll fall by more. But more importantly, they're businesses that can grow. And so, MA Financial obviously had a shocking period in at the start of COVID, the stock fell by 70% in 1 month. It was pretty breathtaking. But the growth, and so at that point in time, it was a small holding for us then. It rose by 7-fold from the lows because its growth was the ultimate determinant of its earnings, and it was just so grossly oversold at the start of COVID. And then technology stocks, you can see the tiniest one or two things that I'll come back to. So if we just go back to now, a quick comment on the economy, but as I said, it doesn't really affect most of what we do. I'd make a couple of quick comments, and that is it's obviously subject to whatever happens with the economic outcome of the tariffs, if they are indeed maintained, but we'll find out. So inflation has obviously come under control largely, although there are risks around government spending. That's certainly stimulatory. And wage inflation, those sorts of things, that can see inflation creep back in pretty quickly. So yes, it's under control, it's been tamed, but I'm not sure it's completely behind us. Real interest rates, but the Australian economy is doing quite well. Weirdly, if you look at consumer sentiment, up until 3 months ago, where you can see it rallied there in the chart, consumer sentiment for almost a year and a half was at the level of GFC and COVID, meaning on this survey alone, most Australians were extremely pessimistic, and that's an interesting reflection of an economy where, at the same time, there's never been lower unemployment. It's weird that we're all working, we're all securing our jobs, but we're also not that well. We're particularly pessimistic. It hasn't really translated into a collapse in the economy. The theory was that interest rates would go up and choke the economy, and then we'd move into a recession, or, well, at least hopefully it would crimp inflation, but the risk was a recession. It didn't happen. So the idea that, and the RBA, to its credit, has been quite pragmatic on interest rates. Real interest rates, which is the chart on the right, are really not that low. Not that high. Real interest rates at 2-ish% are telling you that it's not a setting that is completely restrictive. Now, everyone will have a view on this, so I'm going to be careful not to stray down to too many paths of guessing where interest rates are going. But equally, the economy, we would say, is not particularly struggling. Now, things can change. Obviously, the government is the predominant employer of or growth employer at the moment. If that changes, we might see a reversal, or if the Chinese property market really collapsed. I thought the collapse in the Chinese property market would see a more negative impact on the Aussie economy, but it hasn't. So small companies versus large companies, we get this question, is small companies a hot sector, or is it overlooked at the moment? We would say it's relatively overlooked, and the performance of large caps versus small caps is graphed here over the last few years. You can see in 2022, small companies underperformed and have really not closed that gap, and that tells you, if nothing else, that it doesn't feel like a hot sector to me. We don't really care about this, frankly, because we're invested in it anyway. We'd rather a sector where there are fewer people rummaging around looking at the stocks we're looking at, because we can find value more readily. And then the IPO activity, you can see, is down to almost nothing. There's been 2 or 3 deals, but again, hot markets. If you're worried about coming to the party late, you would worry about coming to the end of an IPO cycle where things are overcooked, and we're certainly not. Doesn't look like that to me. I've got some recent purchases and sales in our portfolio here. I'll just deal with Webjet. It looks like 2 companies. It was actually one stock, and then they split. We sold the online travel agency straight away when the split happened, and then we had a very small holding in the Webjet, they call it, but it's the hotel wholesaling business that had a profit warning. We were a bit wary on some of the quality issues there, having done a lot more work and sold a lot of the stock, and it fell 20%. We sold out. It's fallen more since. But anyway, that's a company that we reassessed. The reductions there, those 3 stocks there are profit taking. The companies have done quite well. There's nothing wrong with them other than the share price ran ahead of our comfort levels on the valuations. Weirdly, you can see also in the same period we increased our holding in generation development. The stock was up 90%. So when we were buying at the start of the period, we were selling at the end because it had run so hard. And you can see there's 3 new positions. They're all very small investments of ours. Beacon Lighting is a retailer moving into the trade environment, and we can hear echoes of what Reece Plumbing was very successful at. They used to just sell taps and shower curtains to direct to consumers, and then they moved into the trade to plumbers, and that's where their real growth came from. It was one of the better growth stocks in Australia for a long period of time. Now, Beacon Lighting are moving out of, not out of retail. They're, in addition to their existing retail operations, are moving into the trade, selling straight to Sparkies and growing very well. Embark Education, I'll come back to, and Fiducian is a small, diversified financial planning platform and funds management business, which we like the look of in a growth sense. And I've mentioned Breville, and we'll chat about the others in a second. So that's that. Probably best now if I take you through a few stock stories. Basically, what we do for all the views on markets, and we have to respond in a setting like this to broader views on markets, because there are topical things in everyone's world. But in reality, what we do, every single thing we do, is related to the individual stock we're looking at the time. So even this pie chart, when I talk about that, we're not looking to build the portfolio to look like that. It's just how it has always looked, because when we look at the individual stocks, we always favour companies that can grow without the cycle helping them. So generation development is, and we get to know management very well as much as we can. So this is a stock that we have been in contact with for a number of years. It's changed a lot over the last 2 years, and so we originally it was a. I'm going to just take this to the chart on the left of these three. There's too many numbers here, but I'll help you. Originally, up until 2 years ago, Generation Development just sold investment bonds. It grew very well, and it's tax effective. It's got a life insurance license, so it's able to. It's a big barrier to entry, and you can see there the product was growing at about 27%. Very well run, very consistently delivering, but the stock itself was not particularly liquid. It wasn't a big company, and so we liked it without being able to invest in it, because it wasn't big enough. And then about 2 years ago, they bought Lonsec Investment Solutions, and we know Lonsec because they rate us as a fund. We also know them because they're a client of ours. And you can see Lonsec is the bottom half of that chart. You can see there, this business is growing very, very well, and it's mostly through its asset consulting business. They offer a service to financial planners to advise them, or really sort of outsource it's called under an SMA structure, which what they're looking to do is take some of the investment process off the hands of the planners, so that they can spend more time talking to clients and boost their productivity. So SMAs are about 15% of the total market, but they're growing very well, and it's because of that productivity benefit to the planning firms. So when Generation Development bought into Lonsec, they bought half of it. That was when we invested. We thought, that's a great business. It grows very well. It's very consistent. Maybe they'll buy out the other half, and maybe they'll establish a bigger business. Well, so we invested very quickly, and then they raised money to buy out the other half, and that was at $1.95. We invested much more, and at that time the stock became more liquid, and then it ran very quickly because the outcomes were so good with that business. And then very recently they bought Evidentia, which is Lonsec's biggest competitor, in a deal that we think makes a lot of sense. And the chart on the top right-hand side is the growth in the funds under management of Evidentia. So you can see it's gone from advising on $2.5 billion to almost $30 billion in 5 years. And that $30 billion is just if they kept their current planning groups they've got now, shift all the FUM, or well, about 2/3 of their FUM over to Evidentia. So stocks that have graphs like that we really love, and as there's some market exposure here. If the market falls, these guys will, and they've had a short-term correction on the basis of that, and a minor delay in one of the mandates that Evidentia is able to bring over. But it's not something that we would be overly concerned about. It's a big investment for us, and it's because hopefully in 10 years' time, when I'm doing this webinar, the charts are just that with 10 more years on them. It's that sort of growth that we love. And SMAs, as I said, it's about 15% of total market. 85% is still individually advised by planners, which involves a lot more paperwork and potentially value, depending on the planner. But we think that 15% will keep creeping up, and that Lonsec and Evidentia could be running a hell of a lot more money over time. Technology One is a stock that we've held for nearly nearly 20 years, I'd say. It's about 18 years. It's done phenomenally well. It's a software business that sells in direct competition to Oracle and SAP. They sell to the education sector and small government and small government organisations predominantly, so that their sector, their customer base is not a cyclical customer base. It's not like selling into the housing sector or financial services, which has good and bad years. Very stable, very, very clever technologists, and the founder is still, the founder and key management have all been there for a long, long period of time. They've been growing earnings. This is the chart that we love to witness, and this is the earnings growth over the last 14 years. The red circle, well, it's not a circle, it's an oblong shape. It shows you that it looks like earnings fell in 2018. They actually didn't. It was just a change in the accounting policy that was put through in that year. But again, that's the sort of growth we love to see. And for a company that we've held for 18 years, we hope they can, and we've got every reason to believe they can continue to grow earnings at that rate, if not more, over a long period of time. And in that case, hopefully we'll be owning it for a long period. Just keep in mind also that the stock price had a huge run last year. You can see that blow off. We sold about 2/3 of our holding at that peak. It's come back a bit since as well. And it was just on valuation grounds, not because we don't like it. It's just that the stock had done so well. ALS is there's two facets to ALS. They're one of the largest laboratory services groups in the world. So they receive samples of soil, and they have to test for contaminants. They receive samples of ore, and it's not so much ore; it's the output of mainly in the gold and copper industry, mining industry. So they will then determine the ore. This is in order for the mining companies to be able to bank their mine operations. ALS will determine the proportion of the dirt that is gold. It's that sort of thing. It's called assay, and so there's two businesses. About 40% of it is in mining, and if I can come back to that in a second, the chart at the bottom is what is the other, which is the 60%. You can see it grows very steadily over a long period of time, and it's life sciences. So it's things like environmental compliance, food, biotech, those sorts of things. And the revenue and EBIT earnings have been growing very well. The other 40% in the mining industry has good and bad years. So you can see it is rather cyclical. So in the last 2 or 3 years, you can see a bit of growth there, but a lot of that is acquisition-driven growth. It's not real. The cycle itself. So most of the swing factor in testing for mining samples is mainly around gold, and copper, and then essential technology-based minerals like lithium and the like. And they come and go with the ability of the companies that are looking for the product, the ability of them to raise money to spend on exploration. Now, they don't do it when the price is down. So the gold price was down up until 18 months ago when it started running. And that was when we bought into the stock, because we thought, well, if we get a reversion back, and samples of exploration were still falling by about 20% per annum. So you had a down cycle in the business that is less appealing to us. But equally, we thought, well, if we get a reversion back to a normal cycle there, and at some point we probably will, it was worth taking a smaller investment into to capture that upside. And that's what's been happening. Not necessarily because the earnings are kicking up, although this week they've revealed for the first time exploration activity has turned up. But really, we drew a lot of comfort from the fact that the gold price was running into record highs, so that all of the leading indicator is obviously very strong in the favour of a recovery in the mining industry. Keep in mind that I can't see us, if this business was just the bottom half, I think it'd be something like, I'd be happy to be on the public record of saying we want to own for a long period of time. But because of this cyclicality, there'll be a point in time where we think that potentially the cyclicality is more than captured, and we would rather sell it than buy it. And so we're not in love with it, but it's certainly, to us, it has appeal. Car sales, this is something that, on contrary, this is something that hopefully we will own for a long period of time and consistently own. And really, again, it comes back to the shape. This is their reported earnings back from 2005, and these are the sorts of earnings streams we love to see. Very, very consistent growth. So they make money from the transactions largely of used car sales in Australia. and they acquired businesses in Brazil, the US, and Korea over the last 4 or 5 years, which has boosted their growth. Now, we're always a bit wary of Aussie companies buying businesses overseas. It's a bit of a graveyard. But car sales, weirdly, they've got more expertise than most of the offshore providers, because Australia was one of the first markets to move to predominantly online. So, I guess we always assume that the US is ahead of everything on every other country on every curve ever, and it's absolutely not. I reckon they were probably 15 years after we were to be able to pay for a taxi with a credit card in the US, for example. Some of their infrastructure and industry is very we can be miles ahead. So weirdly, car sales, as the experts coming out of Australia with all this deep history, can move into Korea, Brazil, and the US, which are far less progressed down the path to moving out of newspapers and onto online. And car sales are actually the experts, so they have a competitive advantage. So we can see, again, hopefully, and nothing is set in concrete ever, but we can see that. I'll pull out one observation as well before I talk about the growth, and that is, you can see there during the GFC and COVID, there was certainly no interruption to the business in the GFC, and almost none in COVID. Some of that little dip there in FY20 is just advertising revenue, but you can see it was corrected very quickly. This is not a cyclical business. It's a very, very solid. It doesn't fly around. It's not like the old newspaper advertising businesses. When it was quiet, you had a massive drop in revenue and worse in profits because of your fixed costs. These guys, they charge on volume of transactions, not on value, which have been very consistent. So hopefully, that again, that's something and management teams intact. They're very capable, proven. Netwealth and Hub are businesses that we've held since 2016 and 17. So Netwealth floated in 2017. We've owned it ever since, and Hub since just prior. They are the investment platform businesses that are looking to and have absolutely taken market share from the incumbents, and the incumbents are largely the major banks. Have these administrative platforms which are on older style technology and have lost market share to Netwealth and Hub consistently over this period of time. The stocks have done phenomenally well, and we've been selling reasonably consistently just because of the performance. But if I could just take you to the chart here, it's a bit busy, but I'll just describe it. So blue is Netwealth's market share, and the orange is Hub's market share, and the black as it falls is the other, so everyone else. So it's a bit like when Telstra was a monopoly, and then as soon as the restrictions came off, the legislative restrictions came off, all the other little telcos started eating at their market share and growing phenomenally, and Telstra just died. Well, it didn't die, but it lost its market share very gradually. So when we invested in Hub and Netwealth, the 2 years before this chart started, they had 1% and 2% market share each. They've now got 8% market share, so they are 4 and 8 times bigger in size than they were when we invested. And 8% market share each in a market where the incumbents gone, well, that big group of incumbents has gone from 3/4 of the market to half. I think these charts will still continue in this direction. They've got such incredible competitive advantages in technology, service, low operating costs, and just being more flexible, and reputation. I think these charts will potentially or hopefully just show that over a long period of time, Hub and Netwealth could be again twice as big in 5 years or 10 years or whatever it is. But that shape of graph and predictability of growth is why we love them and have that investment. Catapult. There's one. I'll take you through this and one more, and then we can chat about anything that you would want to take me in the direction of. Catapult is a small investment for us. We bought into it about 18 months ago. We had a holding in 2014. It did very well, and then we sold out because they moved into the US, and we saw that they were going to lose money, and they did for for the better part of 8 years where we didn't own it. Catapult's the world leader in wearable data feedback technology for sports teams. So when you're next to the footy watching the Hawks or whoever it is, every player has a toggle at the back of their neck that gives heart rate, change of direction, all of the physical feedback of their performance. That is then aggregated. The data is aggregated, so and you can track it over time. So, and then also the data is aggregated in an anonymous sense at the league level. So all of the teams in the AFL want to use this because they get the feedback, the industry-wide feedback of things like injury prevention. So, for example, I think it was Cripps who was pulled off the field recently at three-quarter time and held off the field, and I think there might have been one other Carlton player. I'm not a Carlton supporter, so I can't vouch for the other player's name. But anyway, the question was, why are they off? And the answer, as I understand it, was because the coach's feedback was that after a certain amount of time, particularly with more directional changes than not, the risk of soft tissue injury goes through the roof. So that data is because Catapult provided it, and they're, as I said, they're a global player. They actually, when we sold it, they were the world's best, and it's Melbourne technology, so hats off to them. But we just saw them getting distracted and losing money in other areas, which they did. When we returned to it, and we used to visit them, they've had about 4 new CEOs since, and that never quite gelled. We went and saw them when they had their most recent new CEO, an American guy's come out of Amazon, very, very disciplined on cost and narrow product focus. Don't try and do everything for everyone. Just try and get what the core right. And so they ripped out a lot of costs and also started growing the business again. But the biggest shock we got is we just assumed over that 8-year period, well, surely someone else has knocked them off. The technology will have been replaced by someone else, and that'll be it. And it hasn't at all. They're still more than, or 2 or 3 times bigger than their nearest competitor. So and it's because of their technology, but also because of the data sharing. That's really the critical ingredient. So in 2023, when we first visited them, they were still losing 32 cents in the dollar, and it was too early for us. But then when they got to break even and we visited them 2 or 3 more times, we realized this was a significant opportunity to turn around. And you can see now that the profits are now 11% they're banking 11 cents in the dollar, and ideally they can get to 30 or more. But in the meantime, revenue's been growing at 20%. So you can see the share price has had a huge run. And, I guess that easy gain might be dried up, but they only do $100 million of revenue. We think they could get towards 500 million or maybe $1 billion over a long, long period of time. It's all recurring income. And as I mentioned, they're global. It's all, soccer in Latin America, soccer in Europe. These are huge markets. And so the market size is going to be well north of 100 million. And then the last one is a very small investment of ours, and it's always worth pulling out some of not everything we own is like car sales, where we can invest 5% of the fund in it and sleep at night perfectly. This is 1/10 the size of an investment for us. It's 0.5% of our fund. It's a childcare business which had 2 years of sort of struggles. But at the start of that 2-year period, the CEO that we know well through his 2 prior listed entities, S8 and G8, is very capable, very, very canny entrepreneur, Queensland-based entrepreneur, who has twice built up businesses by acquiring private enterprises at discounts to the listed entity multiple and running them at a reasonably profitable level. And if your share price is you need your share price to be, you need to be able to raise money, but also if the share price starts moving, it gets easier to raise money. You're raising money at a better price and buying unlisted entities in the industry you're in at a lower price, and the arbitrage is very favourable. So we watched it for 2 years. We know Chris well, and we could see he had a plan, but it took 2 years to right the ship, so to speak. They're very small. But they raised money recently, and we thought, well, that's probably the time for us to invest a very small amount on the basis that, and they've been making acquisitions at 4 times, but they've been raising money at 4 times. Now, if I can put that into another form of English, we're investing $1 in them, and they're investing $1 in an unlisted entity, which is valued at $1. There's no real value there. $1 just washes through. What we're hoping is that the earnings and the stock to us is very cheap. We think it's worth at least 20-25% more than where it's trading. But if the momentum starts to kick and they raise money at higher prices, they'll be raising $1. We'll be investing $1 at that dollar value. But because ideally, if their entity is trading at a high multiple, they are actually spending that dollar and getting $2 of value by buying, unlisted entities at half the multiple. Now, it sounds sort of that I've just given you a very, very quick précis of the model. But as I said, it's a small investment for us on the basis that if they do try and invest more and ramp this up and they raise money again, it's very difficult to get access to capital raisings unless you're an actual shareholder. So we're not taking a huge risk. We think the industry is definitely supported by both sides of politics. I can't imagine a single, particularly this week, it's topical. Imagine someone running for Prime Minister of this country and saying one of the great things we're going to do is cut support for childcare. Be political suicide. So no one is questioning the amount of support the government is giving childcare. About 70 cents in the dollar spent in childcare comes from the government. And it's very fragmented. So these guys definitely have opportunity to grow. So that is the end of my formal presentation. I'll leave you there with the top 10 holdings, and we've kind of touched on most of them, I think. But anyway, I reckon we have. Anyway, but I'm happy to hand over for questions and on anything, the markets or individual stocks or our approach.
Okay, great. Thanks for that, Ed. We have had a bunch of questions come through, and it's not too late if you still have any that you'd like to ask, just still type it in. First one, you did mention about gold before. How much has the performance of gold stocks contributed to the index year to date? And what headwind are you facing due to your investment philosophy?
Yes, so gold. The small ordinaries, which is our world, about a third of the small ordinaries is gold. Is mining companies, which we don't invest in, and more than half of that third is gold. And the gold sector has gone absolutely bananas. Now, there's nothing we can do about it. We don't stress about it. We look at ourselves versus the small industrials, and anyone who's got a fund that is investing in gold at the moment looks very good. That's all fine, but we've seen this before. It's just not the world we're in. So it's been a headwind in our performance compared to the small ordinaries, because the small ordinaries has as I mentioned, a third of its constituent parts is mining. So you can see over the 1 year period, we have if you track that down, the small ordinaries is down 1.3, but the small industrials is down 3.8. So that resources impact has been about 2.5% difference in the performance of those two asset classes. But as I said, there's nothing we don't stress about that. There's nothing we can or would do about it, because we just don't invest in gold stocks. It's not our world.
Understood. You're obviously speaking with company management all the time. How is corporate sentiment in between last year, when everyone was celebrating a business-friendly US administration, and today?
Look, I think today is different to yesterday, and tomorrow will be different again. So if we talk to CEOs, I'm not being flippant there, but if we talk to CEOs specifically about really what's this trade policy mean, no one's got any idea. Absolutely no one, where it ends, because it keeps changing. The tariffs are on one day and off the next, and so there's nothing management would be able to add. They're the same as me and my early comments. We just wait and see what happens overnight. But the Fed's in no better position, so no one's fully informed. But then but we're before. So remember that the tariffs came in on the 2nd of April, but we had 80 or 90 meetings with management in February, March, because that was results period. Now, the feedback they were giving us was obviously ahead of, didn't include what was going on with the tariffs, but in a more general sense, in the Australian economy, the feedback has been that retail's pretty patchy, and we're not heavily exposed anyway. But also that the labour shortages are actually restricting a lot of activity, particularly in non-residential construction and residential. But the consumer weirdly is not it hasn't fallen apart, but it's just a little bit patchy. But as I said, making sense of the more recent stuff. We're all sitting in the same seat on that one.
Okay. We've got a long-time listener, first-time caller, an investor that's been with the fund for 20 years now. A big thank you. You've had this question before, Ed, succession planning.
So what the question is, what's our plan? Does Steve and I want to do this forever? I don't think I'll be sitting here in 40 years doing a webinar, but who knows? But as I looked, then the next period, I'm not that old. Well, it's all relative, Lana. I don't consider
I
myself
think
that
it's
old.
the grey hairs
Yeah,
that are starting to peek through it.
that's right. Well, they're fake. I just do this for the just for credibility. But no, we're not that old. We're not getting sick of it. It's a really exciting structure. So the business structure couldn't be better. We have full autonomy over what we do, and we have ownership in the business, and so we love what we do. So there's that, and it changes constantly with markets, and we meet a lot of very, very interesting people, the CEOs of and other people involved in these businesses. So we're never bored. We don't get distracted, and we've had 20 years to be distracted and running other funds, and we haven't done that, so we're not going to do that. But then, in reality, what is the succession plan? The plan is that at some point in time, Steve and I will likely move aside, but there'll be a long period where we bring through one or two other people to take it over, and there's about a third of our equity in the business is transferred to them. The ones that are chosen to take it over after a period, we wouldn't put it this way. We're not going to just pop someone in straight away tomorrow. And then, because ultimately we would maintain an ownership in this business, and the best way for us to be comfortable that the ownership that we retain is valuable is to make sure we put in people who think we know what they know what they're doing. So that's the sort of. But as I said, we haven't enacted anything at all. We've never bought anyone up, or trained anyone up, or done anything to date, because we just see it as we can go on for a long period of time. But we need to get smart at some point and find it, and just find a balance around that, and putting in a succession plan that is more than just the idea that we're covered. So the plan is intact in that we're ready to act on it. We just haven't acted on it.
Okay, wonderful. Thank you. You mentioned earlier you sort of get about 7 out of 10 stock calls right. Could you share a couple of examples of where things haven't gone to plan, in retrospect, where you should have bought but didn't, and another that you did buy and it didn't work out, and the reasons why, please?
Yeah, absolutely. So I'm just trying to think. Our worst stock call in the last 2 or 3 years was City Chic, which was a plus-sized apparel retailer, which we were just shocked how bad it went from pretty good to really bad quite quickly, and it just didn't. I'm not sure whether you could blame management. I wouldn't blame management for the investment decision. It was our risk. It was a small investment, but they moved into the US market, where they had a presence originally, and it seemed to go well at the start. Then they bought a business in Europe. And then very quickly that industry turned down in 2022. And it was our understanding that most of what they were selling was staples. So they weren't selling frilly dresses. They were selling sort of activewear and the like. But sales fell by 20% in the first year and never quite recovered. And the stock price fell by 90%. Now, you can see over a 3-year period, it didn't really, our numbers survived. But I reckon that was probably our worst one for quite some time. You'd always say you'd rather not have held it, and that's the obvious thing to say. We don't want to hold anything that falls, but in a portfolio sense, that those sorts of things pop up. But there's nothing, there's nothing that we would sort of take from that and say, oh, therefore we have to change the way we invest. It's the unfortunate fact is that if you pulled out our worst stocks, you'd be horrified at some of the performance in the stocks that we've held over such a long period of time. But it's not the point. The point is, how does it go into the mix of things that we did get right? So I'm not sure if I've answered that question, Lana. There were a couple of parts to it. I think I've touched on one of them.
I think so. It sounds good to me. Are there any opportunities to enhance offshore earnings and global exposure in the portfolio? And in the current environment, is that something you would look to do?
Yeah, look, we do. So as I mentioned before, Aussie companies going global is a bit of a graveyard. I've been doing this for 30 years, and I've had the amount of presentations I've been shown by proud Australian companies who have bought something overseas, and they're going to tell us that the markets are enormous and it's going to be so much better than Australia. And then history shows that the failure rate is very high, and it's because the world is a vastly different place than Australia, and it's nothing personal against those with the aspirations, but it's always very risky. Having said that, absolutely. There's plenty of stocks that we hold which dominate overseas markets. We sold Pro Medicus about 6 months ago. The share price had absolutely, it's been one of the best stocks we've ever held. I think our original purchase price was about $5. It got to nearly $300. So but it is the world leader in software for the transmission of radiology, so X-rays and the like between facilities. It's better than anything in the US. They dominate. The Mayo Institute uses them. They are taking market share. They're phenomenal. So yeah, but then we sold on valuation grounds. We do, and so Technology One has moved into the UK. They moved in about 7 years ago, and they've lost money there until about a year ago. And we always thought, what are you doing? It just doesn't. It's not stacking up. You're spending money. It's not coming through. But to their credit, they stuck it out. And I think they're an exceptionally well-run business, and they've started making money in the UK. And the market is enormous. They've definitely got a great reputation. We think that can continue to grow. ALS is global. The laboratory business, it's very much a global business. Catapult, definitely global business, and we love it because the scale of the market, if you think about it, if they've only got 100 million US of revenue, as I said before, the market's in the billions, and weirdly, that company gets the primary way teams find out about Catapult is from other teams. So the referral base is very strong. They don't have to open offices all through Latin America. In fact, I don't even think they would have an office there at all, but they've got plenty of soccer teams using the product. So yeah, we're all ears, but as I said, we're very, we need a lot of convincing about Australians going overseas. We would have a smaller holding just on the basis that it's always riskier.
Understood. In a tougher economic environment, there's always a risk that small cap companies start buying growth through acquisitions. How do you distinguish between value creating deals and empire building activity before it impacts performance? That's a good question.
Yeah, so acquisitions, again, it's easy to buy. It's for listed companies, the easiest thing you can do is buy something. And it always looks good the day we are given the presentation with the capital raising. It sounds great. We're going to double our size. There's no risk, et cetera. We're very, very skeptical of those sorts of things. Sometimes it makes sense in that if the companies themselves have proven to us that they've bought 2 or 3 things in the past and it's similar to their prior acquisitions and they've got a track record of bedding them down nicely, then the incremental acquisitions do make sense. So that I would, because I mentioned Evolve Education before. And but then when you can often tell when they've bought too much, and even companies that have made 20 good acquisitions can still blow themselves to complete smithereens by one. And it's usually that you can tell from, well, certainly where this is where we're cynical as we possibly can be on companies that make acquisitions, particularly when they buy in Australia and then all of a sudden they're buying overseas. And it's because we think, particularly when it involves a lot of debt, so people, being conservative and then just taking a massive swing. And I'll give you 2 examples. ABC Learning, that didn't go broke. There were skid marks everywhere before it went broke. It did. We didn't wake up one day and went broke. It borrowed a lot of money, bought a business in the US. All of the red flags were there. We had sold out. It had done very well, and it ultimately did go broke. And the other one is Slater and Gordon, which that's one of the best stocks we had invested in. Our original investment was at about $1.50, and they were buying smaller businesses like themselves in Australia. It made a lot of sense, and it went to $8, and then they made a massive acquisition in the the UK called Quindel, which made no sense to us whatsoever. And equally, because it was such a big part of the business going forward, all of a sudden we're investors in Quindel, not in Slater and Gordon. We'd never met them. They themselves were a roll-up in the UK. They had very opaque accounts, so we sold out, and it went broke, essentially. So yeah, we're just keeping, we've got to be, we don't say all acquisitions are bad, but there are quality controls and red flags that we look for. And debt and overseas acquisitions for companies that have done them in Australia successfully, we're very wary of.
Okay, we've had a bunch more questions come through. What is the maximum level of cash you can hold, and what are the circumstances would you consider going to this?
10%, and that's in our, we can't go above 10%. We've only been there once. We try and hold about 2%, 3% cash. We went to 10% once during the GFC because we feared there'd be a run on the fund. Not because of anything specific to our fund. It was just no one knew anything during the GFC. So we thought, well, we better have some cash and we didn't get that run, by the way. So I'm not trying to create one. But yeah, otherwise it's 2 or 3%. We're not a cash fund. We're fully invested.
Okay. And some more color around your reason for investing in couple of stocks, Fiducian, and then we've also had a question come through for Charter Hall as well. So a bit more.
Excellent. So Fiducian is a business. We were shareholders in Fiducian about 17 or 18 years ago when our fund was small. We sold out not because we didn't like it. It was just that our fund got so big that we couldn't actually maintain a shareholding in such a small company. Fiducian's been run by the same management team for, I would say, 30 years. Indy Singh is the key operative. They're big shareholders. They have grown their business very, very methodically. They're not looking to belt it out of the park. They're very, very slow and methodical, building up. It's partly through acquisition, partly through recruiting planners who then use the platform and the fund management operations. And we said to the CEO, Indy Singh, recently, we said, so can you just take us through who's the most recent arrival in your executive team? And he said it was the guy next to him, Raoul, who arrived 14 years ago. So that sort of DNA, if you think about what we love, is management that can grow things consistently. If it's DNA, it's based on the humans applying discipline and a track record, then that's the sort of thing we really like. And then the reason we bought back in is because it had been growing, but we couldn't own it because it was not liquid enough. The share price, stock turnover wasn't high enough until it got slightly bigger, and we took a small investment. And then Charter Hall, we've got a reasonable investment in. It's obviously been a bit of a wobbly one over the last 3 years because of interest rates and the property cycle, but they are very disciplined. To me, they're the sort of the highest quality property fund manager that we could look at. We've looked at lots of them. They've just got a lot of discipline around what they do. They survived the GFC without a capital raising. They were probably the only ones. They're relatively conservative in the way they invest, but also they've grown their FUM. When we originally bought it, I think they had about 7 billion under management, and it's more like 80 billion now. So they're very clever at growing their investable funds.
Okay, great. We're nearly out of time, so I think I'll just ask one more, and then I think we'll have to address the rest offline later. Looking ahead 24 months, what do you see as the most important catalyst that could unlock value across the portfolio?
I'm not sure. I'm not going to give you a good answer on that because it's all completely stock specific. Every single thing. So I'd have to answer that 60 times, and we're running out of time because
that's all good. No, that's all good. Thank you, Ed. I'll just see if there's any other really quick ones that we can get to. Last one. Have you ever considered Felix as a junior pro medicus, or is it too speculative?
Felix, Felix.
Felix, yes.
Or so is it Telix or Felix?
Felix with a T.
With a T. Yes, we were shareholders. Yeah. It's a profitable. They have a profitable product range. The stock price did very well and we sold out, but I hope I heard the Telix as in Telix, but because there is a Felix. But anyway, yes, but it just from our valuation, it did well, and we were happy to take profits and move on.
Okay, great. We might wrap it up there. So thank you to everyone for dialing in, and thank you for your time, Ed. If you would like to discuss the fund further, please reach out to your Pengana rep. We're all on the website. We're easy to find. And we look forward to the next update. So thank you and enjoy the rest of your afternoon.
Thank you.